Thanks for joining David, Kevin, and myself for the market update for the month of April. What a crazy month April was. I'm going to pass you over to the guys and they're going to dissect the month for you. But as always, if you have questions, you want to review anything, don't hesitate to give any of us a call. Thanks, take care, and hope you and the family are doing well.
April was one of the wildest months for the stock market since March 2020 at the outset of the COVID pandemic.
The month itself was kind of like watching an Oscar movie. You had tears as Donald Trump unveiled his trade war against the world, basically, and markets plunged after that. And then big sighs of relief when he paused a lot of his most harsh tariffs and the market bounced back. But looking at the numbers, the swing in the month of April was actually quite remarkable. If you take a look at the chart on your screen, after Trump's tariff announcement on April 2nd, the S&P 500 plunged more than 12% in 4 sessions. Then on April 9th, Trump reversed himself, putting a 90-day pause on some of his most onerous levies, which sparked a 9.5% leap, the biggest one-day rally in 17 years. Since then, the market has drifted higher, with the S&P ending the month down just under 1%.
In Canada, market volatility was a little bit more muted than in the United States markets in April, and the Canadian market finished the month down only 0.3%. So again, there was a similar convulsion when the tariffs were first announced, and then a subsequent rally similar to what we saw in the US. But the big news for Canada, of course, in April was the result of the federal election, with the Liberals winning another government, again, a minority government, and Prime Minister Mark Carney, formally being elected. So hopefully now that we have that Carney's been actually elected, he has a little bit more agency now to hopefully deal with the U.S. Threat and Trump and his tariffs, and hopefully some trade deals will get announced here in the coming weeks and months. That's certainly what all eyes in Canada will be keenly focused on in the coming weeks. So Kevin, can we learn anything from what transpired in the markets in April?
Absolutely. Last month was a great example in behavioral finance, where we saw people basically on a roller coaster watching the markets go down and then up again. And this is really a good reminder that how unpredictable markets can be and how swiftly and how dramatically markets can react to different pieces of news and information. An example that we wanted to go over with people is, while you're riding that roller coaster ride, if you had been an investor who was invested 100% in the US stock market, and you had watched that dip happen after Trump announced his tariffs, and you decided to get out because you didn't want to be on the ride anymore, you would have locked in a 20% loss from the market peak the month previously. Now, what we try to explain to our investors is that when the market is being extremely volatile and it's not something that it can be predicted, sometimes the best thing to do is to do nothing at all. And somebody who had taken that route and gone through the same dip as the person in the first example, but was still invested 100% in the US stock market, once you rode out the rally after Trump paused his tariffs, and even the subsequent continued rise in the market till the end of the month, you would only be down 8% from the peak. So there is value in sometimes just sitting and waiting to see how things transpire and not reacting rashly when information comes out on a daily basis.
Yeah, I think those are great points, Kevin. And, we always advocate to clients to not make rash decisions when it comes to their portfolio, not to make wholesale changes, especially when the market's just had a significant sell-off. As we all know, everybody wants to buy low, sell high, but traditionally what happens when you look at investment flows into ETFs and mutual funds historically is just the exact opposite happens. Usually most people are selling when the market is low and buying when the market is high. That is just classic investor psychology. And it's something that we try and help our clients avoid making those mistakes. Now, if you were somebody who was in an absolute panic earlier in April after the tariffs were announced, you were checking your portfolio balance every day and you were beside yourself, now is probably a pretty good time to review your asset allocation. And asset allocation refers to the percentage of your portfolio that is allocated to riskier assets like stocks versus the percentage of your portfolio that's allocated to safer investments like bonds or cash. Now, a lot of clients are in balanced portfolios, so maybe 60% allocated to riskier assets like stocks and only 40% to safer assets like bonds. That is a traditional balanced portfolio, 60-40. Now, if you were looking at your portfolio value and you're in a balanced portfolio and you were freaking out, well, things have recovered substantially in many client portfolios at this point in the year. If you're balanced or even a little bit more growth oriented than balanced, you're kind of flat now for the year, right? Whereas a few weeks ago it was certainly a bit of an uglier picture. So if you were really tempted to make a rash decision just a few weeks ago, now is probably a better time to be honest with yourself, talk to us. And if you want to make a tweak, certainly now is a much better time than it would have been a month ago. But again, most people, there's a reason we've set your portfolio up the way that we have. It's based on your risk capacity. It's based on your financial plan. So in our view, we shouldn't be having to make major changes, but small tweaks around the margin at certain points in time can make sense, especially if you were feeling particularly nervous in the last few weeks or so. But if you guys have any questions, as always, feel free to give myself, Harry, or Kevin a call.
Take care.